October 19th, 1987, 9:30 a.m. New York Stock Exchange. The opening bell rings, and within 60 seconds, traders realize something is terribly wrong. Sell orders are flooding in from everywhere. Chicago, London, Tokyo, Hong Kong, Sydney. No human is placing these orders. Computers are selling automatically, triggering more computers to sell automatically, creating a feedback loop that nobody can stop, nobody can pause, nobody even understands. By 4 p.m., the Dow Jones Industrial Average has crashed 22.6%. $508 billion has evaporated in 6 hours. This is the largest single-day percentage stock market crash in history, bigger than 1929, bigger than 2008, bigger than anything before or since, and it was caused by a financial innovation that Wall Street promised would protect investors, eliminate risk, make markets safer. They called it portfolio insurance, but it became the weapon that nearly destroyed global capitalism in a single trading day. Hit subscribe and comment which city you're watching from, because the same algorithm-driven trading that crashed markets in 1987 is happening right now with high-frequency trading, artificial intelligence execution systems, and automated risk management, and nobody is paying attention to the warning signs that are flashing red. Portfolio insurance was invented in 1976 by two Berkeley professors, Hayne Leland and Mark Rubinstein. These weren't Wall Street cowboys. They were serious academics who believed they had solved one of finance's oldest problems: how to protect stock portfolios from crashes. The concept was brilliant in theory, elegant in mathematics. Use computer programs to automatically sell stock index futures contracts when markets start falling. This creates a dynamic hedge that protects your portfolio from losses. It's like buying fire insurance for your stock portfolio. If the market drops 10%, your futures contracts gain 10%, you're protected, you're hedged. You sleep at night knowing computers are watching your money. By 1985, portfolio insurance was the hottest product on Wall Street. By 1986, every major institution was using it. Pension funds, managing retirement money for millions of Americans; mutual funds, managing savings insurance companies, managing premiums; university endowments, corporate treasuries. They all believed they had discovered a way to eliminate downside risk forever, to get stock market returns without stock market crashes. It seemed too good to be true, and it was. The problem was nobody asked a critical question that seems obvious. Now, what happens when everyone tries to sell at the same time? What happens when all the computers trigger simultaneously? What happens when the safety mechanism becomes the danger? Thursday, October 15th, 1987, the market dropped 3.8%, not a crash, just a bad day. But bad enough that portfolio insurance programs automatically triggered. They sold S&P 500 futures contracts in Chicago. This pushed the market down further, which triggered more portfolio insurance programs, more selling. Friday, October 16th, the market dropped another 4.6%. More programs triggered, more futures sold, more selling pressure created. Institutional investors started getting nervous, calling their brokers, asking questions. By Friday afternoon, the situation was approaching critical mass. 5 consecutive days of declining markets had created a massive backlog of sell orders waiting to execute. Billions of dollars of programmed selling queued up. Wall Street went home for the weekend not realizing they had loaded a gun, pointed it at their own head, and their finger was already on the trigger. Monday morning, October 19th, the gun fired, and it fired everywhere simultaneously. Markets opened in Hong Kong first because of time zones, immediate heavy selling, computers triggered. Hong Kong's Hang Seng Index dropped 11% before lunch. London opened next. Computers triggered there too. London's FTSE dropped 10.8%. Panic was spreading. By the time New York opened at 9:30 a.m. Eastern Time, the entire world was already in freefall, and portfolio insurance programs began executing immediately the second the opening bell rang. Here's where the death spiral began. Portfolio insurance wasn't just selling stocks, it was selling S&P 500 futures contracts in Chicago. These are derivatives that track the stock index. This created a price gap. Futures were trading below the actual stocks they represented. Arbitrage traders saw this gap and realized they could make money. They started selling stocks in New York and buying cheaper futures in Chicago. Free money, risk-free profit. Except this arbitrage selling pushed stock prices down further, which widened the futures gap, which triggered more portfolio insurance selling, which created more arbitrage opportunities, which pushed stocks down more. A perfect feedback loop, a death spiral that fed on itself. The New York Stock Exchange computers couldn't handle the volume order processing systems, were designed for maybe 300 million shares a day, but 600 million shares were trying to trade. The systems crashed. Traders couldn't get quotes, couldn't see prices. Phones stopped working because every line was busy. The designated market makers, who are legally required to maintain orderly trading and provide liquidity, simply walked away from their posts. They refused to buy. They watched stocks go no bid. Some stocks didn't trade for hours. When they finally did trade, the prices were completely disconnected from reality. By 11 a.m., the Dow was down 15%. By noon, down 18%. By 1 p.m., rumors started spreading that the New York Stock Exchange would invoke emergency powers and close early. Mutual funds were facing massive redemption requests from terrified investors. They needed to sell stocks to raise cash, but they couldn't sell because there were no buyers. The entire financial system was seizing up like an engine without oil. Banks were refusing to lend to each other. The commercial paper market froze. Some economists later calculated that the financial system was approximately 2 hours away from complete collapse. The Federal Reserve Chairman Paul Volcker made one phone call that saved the world. He called every major bank CEO in America and delivered one sentence: provide liquidity or the system collapses today. Banks started buying stocks. Morgan Stanley, Goldman Sachs, Citibank. They stepped in and bought. The futures gap began closing. By 2 p.m. the free fall slowed. By 3 p.m. bargain hunters emerged. By 4 p.m., when markets finally closed, the Dow had lost 22.6%. $508 billion of wealth had vanished in 6 hours. Portfolio insurance had failed spectacularly, catastrophically. The product designed to protect investors had instead amplified their losses by creating synchronized selling. The computers that promised to eliminate emotion had created pure panic. The innovation that was supposed to make markets safer had nearly destroyed them. The aftermath came fast. Portfolio insurance was essentially banned. Nobody would admit they used it. New trading rules called circuit breakers were installed to automatically halt trading if markets fell too fast. Regulations required better coordination between stock exchanges and futures markets. The SEC investigated, Congress held hearings, reforms were implemented, but here's the terrifying truth: the fundamental problem was never solved. Wall Street still uses computer algorithms to trade automatically. High-frequency trading accounts for 70% of all stock market volume today. These algorithms are faster, more complex, more interconnected, and more opaque than portfolio insurance ever was. The difference is that in 1987, computers could execute thousands of trades per second. Today, they execute millions of trades per second. And the next time they all decide to sell simultaneously, the crash won't take 6 hours. It will take 6 minutes or 6 seconds. Subscribe now and share this with someone who thinks markets are safer today than they were in 1987, because Black Monday taught us one lesson that Wall Street refuses to learn. When you automate panic, you don't eliminate risk. You just make the crash happen faster. The algorithms are still running right now. The feedback loops are still possible. The synchronized selling can still trigger, and history shows us that the innovations we trust the most, the technologies we believe make us safer, are usually the exact mechanisms that destroy us when everyone uses them at the same time.